Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Garmin just reported their first quarter results, and there were some points of strength and some points of weakness. But this is one of the most interesting companies in the technology, consumer goods, and fitness space right now because it's up against a lot of big competitors, but it's actually holding its own in a lot of different ways. Seems to have carved out a really nice niche market. And that's a point of strength that it's going to leverage over the next few years. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's get right to the results. I'm going to start here with the high level income statement. Net sales down 2% in the quarter to $1.15 billion. Gross profit was down a little bit, but still really strong at 57%. And earnings per share on a pro forma basis, $1.02 per share. That was down 8% from a year ago. I'm going to go through this segment by segment, broken down the way that the company reports its operations. The fitness business was reported 11% growth year over year. That was pretty solid. But operating income was only 11% and operating margin is only 4% in that business. This is a lot of the consumer products that are going to be a little bit lower cost than a lot of the other competing products that I'll talk about in a second. So the Forerunner 265 and Forerunner 965, these just simply aren't the high margin products that you would like to see Garmin selling more of. A lot of those products fall in the outdoor segment. So the Phoenix 7. So the Phoenix 7 is a great example of that. That's a very high margin product. But revenue was down 27% in the outdoor segment. Operating margin was still 23%. So great operating income for the quarter, but obviously results were down. And that was hurt in part by the launch of Phoenix 7 a year ago. So the comps were a little bit more difficult in the quarter. Aviation continued to grow 22%. I think this is one of those stalwart businesses for Garmin and something that a lot of us don't really see a lot, but very profitable, very stable business, 27% operating margin, $58 million in total operating income there. So really strong results in aviation. Marine was, again, pretty good, up 10% year over year, 26% operating margin. So these segments put together, aviation and marine, are really the core of the profitability. And then there's a lot of upside from things like outdoor and fitness. Auto OEMs is one of these businesses that I wonder if Garmin is going to get out of this business eventually. Only $81 million in revenue, negative operating income of $20 million, negative 24% margin. They did say that they began production on some products for BMW vehicles. So that's going to be coming out here soon and will likely impact revenue in the next couple of quarters, but not a great result from the OEM segment. But one of the strengths for Garmin is that it has a great balance sheet and it is cash flow positive. So $2.7 billion in cash and marketable securities, inventory of $1.8 billion. So it's got plenty of inventory to serve customers, and generated free cash flow of $232 million in the quarter. This is a company with about an $18 billion market cap. So it's a strong cash position, strong cash flow, and they are using some of that money to pay a dividend and to repurchase stock. At the end of the day, I think Garmin is a really great niche business. It's not going to be a high growth business. It's not going to be the kind of company that generates tech type margins, but it can be profitable and have a very loyal following from its customer base. I've been using a Garmin watch for a number of years now, and I think it's just a great product. I'll probably upgrade, and I've actually moved away from products like the Apple Watch to buy a Garmin. But from an investment perspective, what I worry about is that it's still just too expensive for investors. PE ratio is about 20 right now. And like you can see from these results, sales are declining, earnings are declining. So that's a pretty expensive price for a company that's going backwards from an operational perspective. That PE ratio will likely rise a little bit in the future just because of those declining results. So while I like Garmin's business, I like the cash flow, I like the balance sheet, I just like a better entry point from an investment standpoint. So not a buyer here today, but definitely on my watch list. But what do you think about the results from Garmin or this as an investment? I'd love to hear your comments in the comment section below. Don't forget to subscribe to Rive Investing. Thanks for watching, everybody. See you here next time.